Good morning, everyone. Welcome to today's Energy Update webinar. As usual, I'm joined by Mike Korn. Good morning, Mike.
Hey, good morning, Brynne. Good morning, everybody.
I think it's kind of fitting that we get to mark this coldest day of the year with a webinar.
Yeah.
You and I both being in New Jersey. It's not the coldest place in the U.S., but it's cold today.
Yep.
So, we just had the inventory numbers come out this week for week ending January 25th. I wish July. And the market was expecting a draw of 184. That's where the weekly inventory futures settled last night. And we came in at 173. And, I sort of say the same thing every week. For the most part this year, it's been the big picture that matters and not the deviations per se on the individual days. I suppose the interesting thing to note this week was that we finally broke the trend of salt storage injections. And over this last week, they pulled 17 out. You would expect that would continue to look that way for next week's draw. But we'll see. So I think in a lot of ways, maybe it was good that we were having those builds leading up to this. And then I always like to just, take a look at the overall picture, on the left from the EIA website. You can see, we were just so outside of the 5-year range coming into this season. And, with this week's number, even though we finally managed to post something that at least is comparably higher than a few historical years, the damage has kind of been done in that, we only have 10 weeks left now in withdrawal season, and we've gone through 12. So let's take a look at what the futures look like and how this week's number fits into that. We had, prior to today's number, our inventory level was at 2370. And with today's draw, 2197 that we were at. And you can see the futures for the next 2 weeks down here in the brown withdrawal numbers, projecting 250 for next week. And then the following week, 110, which would put us at 1837 through that reporting week that comes out on February 14th. So from there, we would have then 7 weeks left to continue to draw and hit where projected end of season levels are sort of being shown via that futures contract at 1330, which really interestingly, this whole season, even coming into this at the beginning in November into the winter, even with our inventories being so far behind, that end of winter number has stayed pretty much in line with where we ended inventories last year. And you can sort of see that as maybe a projected, we don't have any other targets, so let's use where we were last year. But now as we get closer, you can see how that would happen. And we're going to talk a lot about that today, Mike and I, just the price action that we've seen versus, at some level what people have expected given the weather that we had this week. And how you can sort of put all the pieces together looking at some of these storage numbers in a different way. So we'll get back to that in just a minute. Here's my favorite winter to date draws by year, with this season on the bottom and then going all the way back up to the 13-14 season on top. Since at least a month ago, we kind of started underpacing all other years for our storage draws. And, it's due to Mother Nature. And those are things that you just don't know at the start of the season, but end up having they made such an impact on, the overall picture that you had at the start of the season versus, where you are now. Because, the more you move through these months, the lower the probability is of severe cold weather, because you just sort of round into March and you have the southern states that don't tend to have as much risk to these kinds of freezing temperatures that we have in January and February. So you can, we're right in pace with the amount of inventory that we had drawn by this time in 2015, 2016, which, if you look at it, that was one of the more bearish years in regards to price action. I think that's when we hit some really ugly lows, but we did start with much, much higher inventory levels at that time. And also, still just right on the low end of our average weekly draws, which is in the yellow here, on each, by year. And so to date, through these 12 weeks, we've only drawn around 84 average a week, which every little bit on these weekly averages really starts to add up and make the picture look much different. So if you just think about that for a second, so we've drawn 84 a week for 12 weeks. We have 10 to go. You can see the next 2 weeks, look at 250 and 110. Do you expect we could average that level for the last 10 weeks? Or, as we get to the end of March and those numbers start to get small, and, there are years that we see small injections the very last week of March, just as we also see small withdrawals the first couple weeks of April. And that tends to kind of do a number on summer averages. So there are still definitely wild cards out there. But, I think the big story has been, the big price letdown. We had this great anticipation coming into this winter season. And if you think about last fall and everybody, it was big news, the natural gas price run up, and it was memorable and significant. And it almost felt like a sign of even bigger things to come this winter. That first cold spell, certainly, nobody expects that, cold weather that hits at the beginning of November, that it won't be topped by even colder weather in January or February. So the fact that we had futures run up to $5 during that time period, it seemed, to set expectations in people's minds as to how prices would react to the next cold weather event, and that we might see things, and price levels even higher than that. And that's always such a tough thing, because people have that sort of history fresh in their minds. And whenever there's been a commodity that has shown you a potential for a price level, it's hard to not expect that to happen again. It's hard to get that out of your mind. Just like it was hard for a long time to get $100 crude oil out of our minds. And, and at some level, it still seems possible, right? Because it's happened before. It's only when things like completely exceed levels that you get new expectations. But, so we've had this fresh, this fall, early winter price action run up that set expectations. And then bam, we had a big weather failure. And week after week, our draws weren't there. And all of a sudden, the whole picture changed. But that isn't to say that we didn't have price spikes. It's cold, and the way cold is usually expressed in the natural gas markets is in constrained areas. And by constrained, I mean pipeline constrained areas. So when we have, temperatures that basically will force demand to exceed the amount of pipeline capacity into or out of the region, you end up seeing prices spike. And honestly, the large component of that overall price is the value of that transmission. Essentially, if there's only let's say 5 units of transmission space into a region, and normally you only need 5 or 4, and all of a sudden a forecast you need 10, those people are going to scramble to get their hands on those 5, and so it's not that simple. But if you were to boil it down, a lot of the reason that we see these price spikes in these locations away from Henry Hub is really pricing in the part of the equation that is constrained. And so here, you can see all through December, and I'm looking at sort of Henry Hub and the mid-continent and the East Coast. I can just as easily have the West Coast on here, and we would see some similar price action, but the map and everything gets too big. So looking at just the Midwest and the Northeast, which is where this cold event was this time anyway, here we start sort of around Christmas, and we know how mild temperatures were then, and everything was really, prices were generally all grouped together, and the spread between any given location had to do with the cost of transmission in an unconstrained environment. And then all of a sudden we get into January, and we had a cold pop. We had the pipeline explosion up in around this TETCO M3 area. And it was a particularly tricky area where this, pipeline disruption happened, because it's right in the Marcellus. And it's an area where gas normally can either flow south or flow north. And it really just, you can see even here, as prices took a dive when, originally, in the moment that the news came out, because it disrupts a lot of schedules, and things just end up having to get unwound and booked out. And then all of a sudden, we come back into this cold event. So we've certainly, you can see Algonquin, here we are on the East Coast. That's the one you'd always expect of this group to be the highest price, because it's the most constrained. And then you have your neighbor over here a little bit to the west, TETCO, and that's sitting kind of around the pipeline constraint, made worse by the explosion. And then you have over here in Chicago and Ventura, kind of in the Midwest, and those are locations that are more accessible from other parts of the country directly, right? So from kind of the Southeast producing regions. So while they're certainly the prices spiked up into the $6 and $7 range, price always shows you so obviously where constraints are and supplies can get to. So it's not to say we haven't had price spikes. If you want to compare some of these to last year, we saw TETCO and Algonquin hit upper 70s, upper 80s on that cold event we had in January last year. So it doesn't rival that by any means. But every year that we have these price spikes, the system gets smarter, and it develops a plan for the next year. And if whatever it was that caused them to have to pay that much for gas last year is something they'll try to fix for the next year. And that works as long as there isn't a different problem. And what I mean by what they would do to fix it is they might discover in a price event last year that they didn't have enough demand response contracts signed with some of their customers. Maybe they didn't have them structured right. They were paying too much for them or too little in order to entice customers, essentially. And you saw that in the news today. A lot of up in Michigan, they certainly had a fire in their system as well. But their lever they can pull is to get plants to shut down for a few days and curtail their demand. So it just seems as we go through these year after year after year, unless it's a new problem, the market continues to learn how to react on the demand side, which did not happen earlier, in the 90s and early 2000s, as these markets really were deregulating. It's not that long ago that just even the pipeline system, was deregulated and open to the public as far as, being able to buy space and move gas around. It really, early 90s. So the system just continues to learn. And I just want to point that out because I think, people like to look at history and then make analogs or comparisons using data. And I feel like what's always missing from that equation is how the demand side has evolved. So with that in mind, let's take a look at a chart here of the production side. The purple line is an average of kind of the three main production basins, the shale basins, right? So I have the Appalachian region, the Permian, and then sort of in the Rockies area. And if I take average prices of those three and compare them to Henry Hub, which is our black line, we start from January of last year and we're kind of all the way here to January of this year. And what I thought was interesting is, last January, we had some significantly cold weather. And I think I'm correct that it was a record at the time. And yet this year, in the last 12, 13 months now, this is the first time that we've seen, and I kind of try to blow it up a little bit here, the purple line, for a couple of days, the average price at the production regions coming in, as far as how they've, settled the index for the day, just slightly higher than Henry Hub. And I think that's something to, I'm certainly going to ferret this out a little bit more. It could be just, anomaly, short-term event, but it does say that we have and continue to work really hard to get this gas to market. And depending on, where the cold event is, especially when it's in the Northeast, right, you can get prices in and around the Appalachian shale region that can pull that average up, right? Because now that has better access to the market than any gas that Henry Hub does. So just interesting, the dynamics of that. And then another way to look, at this event and the cold event is through electricity demand. And I know you guys know this, I always look at PJM. And this chart, really, the blue bars are this year, peak demand by day, and the brown bars are for the same day last year. Same with prices. The gold orange line are real-time on peak prices at PJM West Hub by day for this year. And the white line is what the month averaged, the average of the daily prices was for the month. It gets a little bit noisy to compare all the individual days prices. So, but you can kind of see where it is average versus this year. And, here's our cold event. What's interesting is that yesterday, so this is today, the 31st, yesterday PJM was forecasting 143,500 roughly for peak demand. And that would have been a new record. The all-time record was set in 2015. It's been it's just, we have not been setting records demand side in electricity for a long time, just because of demand side management. So already though, this morning, the last time I looked, this peak demand has been revised today down to somewhere around 139,000. So, no record as it stands right now. And it certainly could be due to a revision in temperatures or the overall forecast, but usually it's due to a demand side action that was taken. So between yesterday and today, they have managed, by they I mean utilities, have managed to get some of their customers to curtail their demand. Shut down their plants. I know a lot of companies, right? They actually like it when they're called on certain days because some of them are very lucrative and they can make more in a day getting paid to be closed than they can operating. And that goes to my earlier point that utilities have learned how to pay enough for it, or in certain circumstances, and so then they know that they can pull that lever. And that was a bit, that's a big change. 4,000, slicing 4,000 off. And I'm not saying I don't. That's the only reason, but it certainly is in the mix in ways that it didn't used to be, when power would often spike into the thousands of dollars for days and certain hours of the day. But then, as we all know, you can see the weather forecast here through the next 4 or 5 days for peak demand forecast in PJM. And, as we know, we go back into the 40s this weekend, and certainly, that backs off, almost 50,000 from today, 40, 50,000 in peak demand. So it's just so significant, and really, it will be interesting, to see what the post-mortem looks like. I think in the midst of the cold crisis and event, people are busy just keeping things running and making sure that no one dies from cold weather. And then, once we get through the event, things get, they true up balances with pipelines. And that's why a lot of times people joke that it's after the fact that prices move in natural gas sometimes. And, of course, because that's the time when everybody can, get back in balance. And, you might draw off the pipeline outside of your allowed range and have a certain number of days with which you can resupply gas to the system and avoid imbalance penalties. All right, so here, Mike, Mike and I were talking about this morning and trying to think about how do we come at this. Sure, we just went through all, these little bitty facts and different charts, but how to look at overall why this price action actually makes sense, or you can make it make sense, and maybe how that will get you to start thinking about, your next move and positioning for the summer. So, Mike, definitely chime in if I'm missing, orienting everybody to this, and certainly just as we kind of try to ferret this out. So sure. What I did here is, first of all, in the bars from left to right, I looked at where were inventory levels at the beginning of each month, meaning, so right here, this is what the inventory level was at the start of November. The gray bar is the 2013-14 season, because that's kind of our, worst case scenario when we ended with really low inventories and it was so cold. That was the original polar vortex. Is that, do they say OG or something like that? The original. But now that's a common term, right?
Yeah, we're going to have to start numbering polar vortexes.
Right. And then 2000, I have the 2017-18 winter season, because of course it was a year where we did have another polar vortex like event in January. And it's, more recent in everybody's mind, and also more comparable as far as production goes. The production picture just keeps changing so dramatically and has evolved so dramatically. It gets more and more difficult to, do some of these historical comparisons. And it's hard to even go back really much before 2012 even. So we've got, our scary year with ending inventories below a BCF. We have last winter, and then in the blue bars, we have this current season. And then on each one of these lines, their colors correspond to the bars. I have where Henry Hub cash prices averaged for that month, meaning I took each individual day's index price for gas and averaged it to come up with the month price. It's not where futures expired. This is actually where cash prices cleared. And so and you just move it forward, right? Here where it was inventory at the start of November, here's where levels were at the start of December, kind of progressing down. Let's first kind of go up until April, and then we can kind of take a look at the summer. But so here's kind of to take you back. So when we were standing in the present time of October, November, the information that we had was this comp as to where inventory levels were and weather forecasts. And that was generally it. And then kind of an idea of where inventories ended, at the end of March, beginning of April, in lots of different seasons. And I just used these two, right? So standing here, it looked a little precarious. I mean, it was easy to make a bull case because you have nothing but weather forecasts, and even using an average winter, you given where we were starting with inventory levels, you could imagine a scenario where the market was going to be tight. And then sure enough, we had an early cold spell in November. And because at the time, you don't know that's, you're going to, what's immediately going to follow that is, a month or two of incredibly mild weather. The market, there was a lot of fear when that first cold, those first cold temperatures hit. It wasn't, it wasn't misguided. It was legitimate, thinking about, well, if this is the type of demand I'm going to have now, what will it look like once we're in the middle of January and February? And keep in mind, at that time, January was forecast to be incredibly cold, and December. I mean, it was, the forecasts were certainly pointing towards cold weather. And so a lot of things happened, right? People got nervous and they bought in the cash markets in some ways to preserve their inventory. So the more you buy in the spot market, the less you have to draw down out of your own storage. And it was kind of a theme, right? Wow, this is how worried people are at the time, that they'll literally protect what they've got in the ground, and they'll pay $4.50 today, $5, in order to still have gas available when we get into January and February. And so we all know what prices did and what happened. And I like the comment you made this morning, Mike, about how it was real, that fear.
It definitely was. Talking to clients, producer types at that point, they definitely were concerned about the level of inventory they had at that time. And I think in the market in general, people were, I just kept hearing that, hang on.
Yeah, that's well, and I mean, it was just really that.
Yeah, and back, I just wanted to say that, at that time, just kept hearing the most quoted statistic probably was, oh, we're this level, which is below the 5-year average. So I kept hearing that along with it could be really cold, but the concern was real.
Yeah, that was a smart tactic, right? To be honest with you, I hadn't really, I expected the future contracts to rally like Jan and Feb more than the prompt contract, until you start to realize, oh, okay, well, it's, an immediate action that they're taking against future inventory levels. So it was real. And then, of course,
and going back, can just bring to memory that one of the first signals of that was, remember the spread action? It was like Novi Dis or Dis Jan.
Right.
Those were like unprecedented levels. So that was even before the spike we had, which I've never seen in commodities anything as dramatic. And following natural gas, you and I, for a long time. Maybe great point. Those were preceding the events. Yeah, but even then, it's like, even if that was a signal and you were on that, whoever thought we'd have that kind of volatility? That was
absolutely. And I only want to go back in time and talk about that part of it because I feel as though some people just write that off as an event caused by someone that was short in the markets. And that's all that was. Position, open interest in markets can move or exacerbate moves. But, to say that was the cause of what was going on.
It was definitely a casualty.
It was a casualty.
Yeah, but
very well said.
Right, and just thinking back to the first polar vortex, I remember there was just a lot more pain, a lot more blood, if you will, in like trading. A number of houses at the time that really got hurt
terribly, and that just using even that example, that was the genesis of the power pool ISO's winter reliability programs.
Oh, okay.
And that goes back to when, how people, the market and the players learn through every event. And these winter reliability programs were put in place because there had been an actual lack of fuel and an inability to generate, I think, frozen coal piles and, the whole deal. And so what these power pools did was they put a program in place that, and anybody who bought heating oil and kept it on site and had backup inventory was guaranteed that they would be, any inventory they had left at the end of the season, they'd be bought out at cost. So they wouldn't lose any money. It was like they had, there was a put essentially in that overall thing. So it basically incented people to get heating oil on their books and have an on-site so that there would be backup fuel. And so now, there is backup fuel, right? And we've learned a lot from that event. So that's kind of setting the stage to where we were and what people have in their mind as to what happened then, last fall. And now let's step forward here. Now we're at basically the start of February. After, today's numbers, you can see where, how inventories now look, right? I mean, these other, kind of comparable years went through more extreme weather during these first 3 months. And all of a sudden you turn around and here, we're right, we're not really, it's not such an outlier where inventory is. And so you look forward and, we've got March, the start of March, and I know this says April, but it's really what inventory levels are at the start of April, which is the end of winter. And you see here where these draws in these prior years were so significant, and you look and you kind of say, all right, well, let's project the next 10 weeks. And as I said, we already can see 2 of them, and what that looks like. And so here we have this cold event, and people have last fall in their mind, and they're expecting, natural gas prices to rally incredibly, and in a lot of ways. And I'm generalizing, and obviously there's a lot of people who were bearish. It's not like I'm saying everybody did, but it feels like that's where the angst is. Those people who expected cold weather equals higher prices and feel somehow like there's manipulation going on.
Yeah, if you can rally prices after the weather in Chicago, then what's wrong with this market?
Right. That's how many times did I hear that the last couple of days, yeah. Right. And yet, the thing is, not here we are, even with these big draws we're going to have the next few weeks for the, this 2-week cold weather, the weather turns mild again. And so that we know that's not going to continue, at least as of today. Right. And so we're not short. The system is not short. We have moved from when you're sitting here at the very beginning of the season, there is actual fear that you don't have enough in the ground to, make it through, a worst case scenario winter. When you're standing here at the beginning of February, and you have a few weeks left, it's just a completely different feeling, right? It's hard to fathom a scenario under which we could, be in a completely run out of inventory situation by the time we get to the beginning of April. And as a matter of fact, people start thinking about, well, come the end of March, I've got, when you sign up for a storage contract, a traditional storage contract, the terms are you can start injecting in beginning of November, start withdrawing, and stop withdrawing the end of March. So whatever your minimum or end of season balance is agreed upon in that time frame, you have to get all of your gas out down to that level. And which is why so often it's kind of funny. The March-April spread runs, all through the beginning of winter, and that seems to be used as a proxy. But 9 times out of 10, March ends up settling below April because March gas can't be carried forward to April. March gas has to be withdrawn, and April gas can be injected. Meaning April gas can become next winter. You can start, you buy in April, you put in the ground May, June, as long as the spreads are there, you can start converting that gas into, prices for next winter. But by the time but by March, that's over. You've got to get all of that gas out. And so depending on what the weather looks like, sometimes cash gets really just heavy. And there's just a lot of selling just, because operationally, people have contract terms that they have to meet. So,
and I'll just point out, Brynne, that the March is a little over 4 cents premium to April. Remember, just a couple of weeks back, that was over $1 higher.
Well, yeah, and I mean,
that's really
$2 early, in November. It's a crazy spread because, on the one hand, it literally is just used as like a bullish trade. Like if you're going to be bullish, that's what they buy. So, March-April spread versus buying outright. And, before you get there, and the spread could go anywhere. And so people, where are you going to take your short at, depending on how, deep your capital is and what type of stops and limits you have. It's just tough. Sometimes you get stopped out at $1.50, because it's going to $3. I think the narrative from, was it 2007 or somewhere around there, that whole Brian Hunter thing. And that's muscle memory, right? So people still, think about that spread, although we saw this year, it seemed like maybe the market was getting a little smarter and placing those in like the Jan Feb spread or Feb March. It's a little more, it's a little more realistic, right? Yeah. And so here we now are at 4 cents. And, there are so many options that trade on that spread. The calendar spread options, people that are buying the $2 overcall and the dollar under put. And so that's why, March expiration, there's so much open interest in March always because of these. It's just such a popular spread to trade. And it's certainly popular to buy the flat put, March settling flat to April when that spread rallies.
There's also now a lot of folklore about being short, CSOs being short calls on March, April. That doesn't turn out right too.
Yeah, right. So a lot, there is, we even talked about this, last fall, but open interest in the positioning in March. And, a lot of that is due to, around these calendar spread options and the spread itself.
Right.
And so, there always creates a little noise when those get unwound. And now that's the prompt contract on the board. Okay. So I'm not making any like prediction here. I'm just suggesting that you can envision a scenario where, this could be the outcome and this could be the inventory balance we have at the end of April. And the entire market is looking exactly at that, not the individual numbers, but if that expectation starts to really deviate, that's going to be the driver, I think, of the next kind of bull bear overall sentiment here in what's left of winter trading, which is March. But now, let's look forward at summer, because you look at futures prices here and you can see, 2014, how much higher, just even these were, the actual prices were. And the blue line, once we get past, February here, these are futures, right? So the blue is where futures are versus prior years. It's where, the cash index actually ended up clearing. And, ironically, the entire market, once it's had this April, kind of felt more comfortable about where that will be, has sold back down to this area for the summer, which has, existed for the last 4 or 5 years. And I show this chart a lot where, it has kind of the cash price range for all, a bunch of different years. And, this is just such a popular area and range that we've sat into. So, no surprise. But a lot of, taking a lesson from history, just as the market did on the demand side, there are 2 really key differences for summer on these comparative years that we're looking at. So we ended 2014 with inventory levels below a BCF. And the market was really, really nervous that there was no way that we would be able to refill storage throughout the summer to any sort of level that would be helpful for the following winter. So next winter was bid, but futures and prices continued to clear in the above $4 range. And that does a couple of things. Higher prices entice production and also imports from Canada, but they also keep gas out of the power generation stack because it makes it less competitive, which ultimately causes less demand. I'm not saying, there isn't gas burned for power, but, you want to talk about when, for those that have choice, they're always going to choose the cheaper fuel. And just for that fact alone, price led to an enormous inventory build. We built almost 2.8 in that summer 2014. And that was, I remember during all that, it was beyond expectations. The fears that were there, and then the builds that just kept happening. And so price did its job. Now you look at last year, and here we sat, down in this 280 range almost all summer until, we got into October and November. And yet, starting from, which is the black line here, starting from a higher ending inventory balance, we put almost 1,000 BCF less in the ground during that summer. So really low prices have the opposite effect in that it's gobbled up in the power sector, right? It is the cheapest input fuel, and certainly, is the incremental fuel of choice from, other than wind and solar. But, there's so much competition as to the cheapest, marginal megawatts. And here you can see the difference that made. And keep in mind that last year, just even the production growth that we had from 2014 to 2018. And I think, all summer, people were kind of lulled to sleep a little bit. There's just this production story, and it's why they just couldn't get the winter to rally, even though inventory was looking so behind, because it was the fact that people just really believed, and it was true, the production story. It's just that if you create more incremental demand for it by, keeping prices at that level, it's not going to go into storage. It's going to get used. So I bring that up because here we sit with a futures curve now for 2019 for the summer, that given, if inventory levels start at the same place as they did last year, it seems like we maybe could have learned a lesson, or you have to start to decide, well, okay, what's different, right? Do we expect a really mild summer? Do we expect, an even more incremental production growth relative to export growth? The new LNG terminals coming online, pipelines into Mexico. What is it that can make you, think that, the perfect supply story is priced in, and what would, cause you to move off of this, right? A mild summer would certainly probably put a nail in this coffin, and we might see the downsides we saw in 2015-16. But until then, it just like until winter, you don't know, right? If what it's going to look like. And so I think it will be really telling as we, start getting into April and May and watching these spreads. Because last summer, all the months remained in backwardation. And, it was kind of a sign of, the demand for gas at these cheap levels, but the unwillingness to, take that as a signal for anything going forward. And backwardation does not entice molecules into the ground either. Right now, the curve for the summer has moved into a bit of contango, but I think that's going to be the thing to watch, is how some of these summer spreads start to act, especially as we get into April, when all of the nuclear power plant maintenance and coal plant, that's the heart of power plant maintenance. And so gas is there's not, they don't really have the opportunity if demand hits, if the weather is either colder than normal or way warmer than normal, and demand is, above normal. They don't have the option for that base coal plant or for, any of the fuel switching. So a lot of gas will get run during that month. So, before we put, stick a fork in it and call it over, I think there are still so many interesting things to look forward to in this market, and especially at these price levels. We're priced to sort of a perfect story that lines up completely with analog years and history. And I think, there are a lot of ways that you can look for a signal that comes into play. And I think, Mike, for you see a lot of people that like to hedge around that range.
Yeah, I'll also, before I mentioned about summer, and a couple strikes that I have people looking at, not so much on the production side, but as spec. But before that, though, the question is winter over? I tend to think it is. But the thing I've learned and discussing markets with you over this entire winter is even more important than supply. It's about supply constraints. And you've said, and I'll quote you, that prices are rising for pipeline space. And I think that's what I've learned about this winter and discussing things with you, that it really comes down to that. For the summer, if you have a moment, I just wanted to bring up one of the strikes that some of the spec stuff I'm looking at are out of the money calls, calls that cost no more than 2 cents or $200 per option. I mean, all the disclaimers, about risk, et cetera, are in place, right? But the June, because you and I talked about, our straddles a good purchase, and I want you to give your view on that. But what I am seeing is some interest in out of the money calls, like a June 340 call is $0.015 roughly, and that's just
that was
keep in mind.
Those ultimately, there were a few months where those teenies worked, right?
Yeah.
And then we went into this whole period where nothing was cheap because vol was so high.
Right.
And actually now, I just read yesterday where implied volatility for March hit its lowest level for this time of year in history, right?
Yeah. Who would have thought after the spike we had with hypervol?
Yeah, and so it's corrected all the way to the other side, and you look and you think, and you're coming to straddles. I don't know. I mean, it's hard to think that there'll be the price action, and yet that's just when the story changes. But I think I don't think there's not enough information yet on that, right? I actually think just long or short, based on your own personal, with your research expectation of what will be different. Is there something that brings us to a mild summer, so it collapses this down to just new low $2, $2.25 area below that, or is it a situation where we have an extremely hot summer, and when we bust above that 310 strike that all the producers have sold, right? When they do those fences.
Right, like buying a 280 put, selling in this case like a 305 call or so, but 305s, 310s.
Yeah, and so
actually,
keep that in mind.
$3 calls actually right, here.
Yeah, and that's an area that needs to be, to be pushed through in the summer on the upside to, cause angst for hedgers. And it's just been years since that's happened.
Yeah, by the way, I haven't really seen any extra interest in natural and the options this week as we've been making lower lows. what I'm seeing, just so you know, energy wise, is more activity in crude at these levels, like near the $55 level, for the balance of Cal 19.
Yeah, we're going to hand off now, right? From boring summer natural gas to, interesting crude oil that seems.
Yeah, but from what you said, I really want to keep an eye on the natural, because you're setting the table for the winter. Are they going to are prices going to be an incentive for putting things in the ground or not?
That's right.
I appreciate that, because I never really looked at the market in those terms, and that really can discuss with you.
And as a and because I know where it's, almost an hour just went by like that, Mike. So before I wrap it up, one final thing on along those lines is, so I have this final blue line here in November. It's not like I think it's anything other than an estimate, but if you would look at where end of storage season futures are at the moment, it's 37.50. And it's just because it's not in anybody's wheelhouse yet, but that would mean we would be injecting 2.4 this summer. And can you get that much more in the ground at these price levels without incredibly mild weather? So those are questions. I wanted to set this up because before, people kind of get all, upset with natural gas that it didn't perform in a cold, event, and therefore, there's nothing looming on the horizon. There's a lot still in play here. And I think, I just wanted to point out some of the ways to look at the market for signals. So anyway, anything else, Mike, or are you good? Did I get
I just had to get that. Sorry. So what I'm hoping for next in natural is a good tradable market. So I don't mind if, we tend to trade close to, or to trade in a trading range, but at least seeing activity where you can dabble in options that are like, 2 weeks to time, 2 weeks to expiration, and trading for some gamma.
Great point. I mean, actually lower vol markets bring
lower vol, but as long as it swings and has some range and some action,
right.
It's fine.
Right. It
do that.
You play in it a little more reasonably with expectations. So, all right. Well, hopefully we're going to survive this last little bit of cold, and everybody else will. And it was great to talk to you today, Mike. And
thanks, Brynne.
Hope everybody has a great week. Thanks.
Stay warm.